Hello and welcome to the Vinva Systematic Equities Quarterly Update. I'm Laura Mitchell, Key Account Manager at Magellan Investment Partners, and today I'm joined by Trent Larcombe, Lead Portfolio Manager for the Vinva Strategies. Welcome, Trent.
Thank you. Thanks for having me.
So Trent, this quarter we've had the launch of the Vinva Global Alpha Fund active ETF on the ASX with the ticker code V1AC,
V1AC,
plus a hedged version. What does that open up for advisors and retail investors in the Australian marketplace?
Yes, well, firstly, it's very exciting to launch our first ETF on the market. So, as a firm and a business, we're excited about the prospect. I think essentially the ETF really gives, a wide-reaching audience access to our products, our global products, which is great to see. It's a dual access product, so it has the listed version, which can be accessed on exchange, and then it has the sort of unlisted version, which can be accessed through the platforms. And then it gives investors the opportunity from a hedge perspective as well, which there's a hedge product available in this product. So if people want to hedge out sort of currencies, they can do that through the hedge product, which is available sort of on the unlisted via the platforms.
Great. So turning to performance now, how did the global and Australian strategies perform this quarter and what drove those results?
Well, firstly, it was another interesting quarter we had. I think the S&P 500 had its best quarter in about 6 years, so plenty of geopolitical and macro sort of movements throughout the quarter. Powell left the Fed, as we know, so I think it was in May, had the energy sort of crisis continue to go back and forth with regards to that. So plenty going on, and the CapEx within that sort of data storage, data center world continued on in the US. So pretty entertaining and a quarter full of information, particularly on the macro side of things. From a funds perspective, the global funds slightly underperformed the benchmark. I think it was mainly led through some of our behavioural sentiment and segmentation, the global linkage signals, where our longer dated sort of half-life signals of valuations and quality held up okay. And then in the sort of sector-wise, gold retreated quite a bit. So we had some sort of detraction in the financials and the materials sector, where some of our longs in the semiconductors did pretty well for us in the global funds. In the Aussie funds, pretty benign performance with regards to away from benchmark, so fairly close with regards to that from a performance perspective to the benchmark. Again, it was similar from the sector's perspective. Gold, copper retreated, which did detract from our Aussie portfolio. Consumer discretionary and capital goods did well for us in the Aussie portfolios. But we had a bit of a difference in the Australian portfolios from a signal perspective, where our sort of valuation and quality signals did quite well. And our global linkages and sentiment sort of underperformed over the quarter.
So just moving on, markets have become very top heavy, dominated by a few mega caps. How does a diversified, systematic approach navigate that? And are you seeing interesting opportunities emerge outside of those giants?
Well, I think concentration risk is there and is key to sort of veer away from. And I think the way we construct portfolios, in our global funds, we hold over 400 active holdings in the portfolios. So diversification and breadth is key for us. So that's one thing, to stay away from that top end of the market. I think from an active share perspective, i.e. where we look to place our active bets, is not so much in that uber cap, sort of higher end of the market. From a market cap perspective, we don't see the opportunities probably and the mispricing so much in that area of the market compared to sort of that mid cap, particularly in the US we find that. So that sort of keeps us away from that sort of top end as such, but we hold fairly tight bounds from a single stock active positioning perspective. So we're always going to be there as such in that sort of uber cap top end of the market, but our active share wise, it's probably replaced that in different parts of the market compared to that sort of uber cap top end.
And just regarding those, the bounds, would you like to explain a little bit more about that?
Yeah, so we have fairly tight sort of upper and lower active bounds. So what I mean by that is the active bet we're taking away from the benchmark weight of the stock. So if you think about Nvidia is about 4%, 4.5% of the MSCI with regards to its weight. we hold call it about a 1% upper and lower bound away from that 4.5%. So if we really don't like NVIDIA, we'll hold about 3.5% in the portfolio. So you can see we're always going to be there. We're just that active positioning on the downside is a 1% underweight holding. And if we really like NVIDIA, we'll hold 5.5%, which is 1% over the benchmark weight.
Vinva's long been ahead on data and machine learning. What newer data sources are you exploring? And how do you balance AI's power with the human discipline that stops a model from chasing noise?
Well, I think what we've seen over the last 5, 10, 15 years is a massive increase in data, but particularly the unstructured data. So we're all used to structured data being sort of rows and columns. It's really about the unstructured data that's dominating with regards to that proliferation of data over the last sort of 5 or 10 years. So the ability to consume that is a bit more complex, which is an area that we've been in for a while in that sort of text mining, machine learning, large language processing world and into the AI world. So being in that technology and systematic process, we've enjoyed that new run of unstructured data in that space. So, and it's really important that when looking at data sets, that we know that signals, potentially new signals or existing signals, are going to last through various environments and time and not get caught up in the noise. So it's really about the integrity of the data and making sure that is not a small win over short periods and only really working through particular environments. We've got to make sure it has sort of longevity. That's where the signals are going to last the time. So that's where you've got to be really careful from the discipline perspective within our research team and putting together new signals, that we sort of interrogate that data and do all the necessary testing to make sure it can do well through certain cycles and through certain environments and not just caught up in noise over short periods.
Systematic investing runs on tight risk control. When markets throw a surprise, how do your controls respond and keep the portfolio on track?
Yeah, I think we talk about the skill component of our process, i.e. the signals and insights, but we also do like to talk about the risk controls in our risk model and the portfolio construction of our systematic process. And what I mean by that is what we're really trying to do is ultimately get exposure to the signals that we think are going to drive stock price returns and pick up that sort of mispricing in the market as such. We don't really want to get exposure to unintended bets and big macro bets. So that's where we really rely on our risk model and our portfolio construction process to negate or neutralize those unintended bets or styles that we might be creating if we just let the signals do what they want to do. So that's an important part of the process that keeps us on track. So when there is a macro event, I'm not walking in the morning and having to make a macro decision about the oil price going from $65 to $85 because we've got a large underweight in the energy sector. That's not going to be the case. We've got very tight bounds on sectors and individual stocks, as I mentioned before, but also trying to remove those unintended bets and those big macro bets that we might take. We're not interested in taking those. That's not our skill set. Risk model keeps us on track, so we're not having to make those big sort of macro decisions.
And with the active versus passive debate very much front of mind, what's the case for systematic active equities today, and what's your focus for the rest of 2026?
Yeah, I think the active versus passive discussion has been around for quite a few decades. It's not a new phenomenon. We've seen the increase in money move towards passive products, and we've seen the growth in ETF products over the last sort of 15, 20 years. So that debate's been raging for some time. I think some of the active managers over time have underperformed, post fees and taxes. So that's put a bit more stress on that active space. And I think the debate and the question is really about finding, quality, consistent, active managers out there, not necessarily the style of active manager. And we believe Vinva's been in that active space for a few decades now, been a consistent performer, and I think that's what we're trying to continue to do over time. So the debate's probably around really rather than styles, but more about trying to find consistent outperforming active managers. We know that we're going to go through periods of underperformance. We think over the long duration, there'll be more periods of outperformance.
Thanks, Trent, for your insights today. And thank you all for watching. If you would like further information on the Vinva Systematic Equities funds, then please head to our website.